With all these company results out, let's take the pulse of the markets and the business world. Catherine Allfrey is a principal of WaveStone Capital and, as I always like to remind her, a funds management Hall of Famer as well. Catherine, great to have you on the program as always. Now, we always said this reporting period was going to be about the outlook statement, so just try and sum up the mood for me right now from what you're saying.
From what I'm seeing so far, there's not much in terms of earnings revision change for next year so far, plus or minus 1%. What I would say is that CEOs can see runway between here and Christmas, and so they're feeling a little bit more confident, particularly about the first half. They don't want to call the second half because they know rising rates are going to impact mortgage holders at some point, and when those fixed rates move to variable, that's when it's going to hit, which is more likely in the June quarter next year. And so we'll see this slowing consumption environment in 2023. So they are concerned about that. They're also concerned about a sort of wage price inflation spiral that could occur. They are obviously putting through wage increases through their sub-inflation at the moment, but they are a little bit concerned about that. And of course, rising interest rates leads to increased cost of debt for them. And so they're being a little bit more conservative is what I would say around outlooks, but also around capital management. We know we're not seeing the same level of buybacks this reporting season as we've seen in the past.
And quite often that is actually a real sample of confidence from chief executives when you do have companies buying back their own shares, increasing their leverage effectively. And the second thing is also when they're investing to try and grow their businesses, so their capital expenditure. Now, that's a key, I would imagine. So what are you seeing there? Is there any examples of where companies are really confident enough to go and try and build their businesses now?
Not really. I mean, we've seen some examples of companies like Treasury Wine reporting today, promising really strong growth, obviously been through a really difficult time with the tariffs, with the wine that was going to China in terms of Penfolds is now having to go to a different global, markets, and they're promising very strong growth, which is sort of 20% plus growth for the next year. So they're investing behind that. So that's promising. Car sales obviously have just done their acquisition in the US, and they're spending a little bit more in terms of tech spend. But overall, the resource companies are talking to be quite constrained. There is some projects being developed, particularly in iron ore, but other than that, they're being relatively constrained this cycle.
And what about the big miners? Because obviously we've seen BHP come out. Some of the other miners will be coming out a little bit later. Quite clearly, when I spoke with the Chief Executive, Mike Henry, earlier this week, it's one of those things where it shot the lights out in terms of its dividend payments. And quite clearly, it's got now a strategic view as to where it sees the world going into the future. This is part of the key in trying to read this with some of these companies, Catherine.
Yeah, I mean, we've obviously got very weak GDP prints in China, and BHP are talking, from their numbers that they're seeing that they still think China will recover 6% next year in 2023, which should hold the iron ore price up. It does depend a little bit in terms of supply. Like I said, they're all talking about incrementally increasing their supply in iron ore. However, I would say, they're obviously printing money at the moment. It was an outstanding result, executed exceptionally well. And all of those miners are sitting on very pristine balance sheets. So they can do more in the future in terms of increasing their dividends. But it all comes down to commodity prices, Ross. And we're at a record level of commodity prices. You only have to look at the EBITDA margins that BHP and Rio printed, 60, 70%, which is just obscene.
Off the charts. It is really quite off the charts. Yeah, exactly. No, I did mention that to Mike Henry.
Commodity cycle.
That's right. I think Frank Calabria, I spoke to him today, his return on equity is 7.5%. And I said, well, that's nothing like BHP's, which is 45% plus. So it really does highlight that. Yeah. That's the one thing that highlights the difference between the company's performance, isn't it?
Absolutely. And, poor Origin, facing the, energy debacle that's going on in Australia at the moment. And, that energy markets business is really suffering. Obviously the profit was around 380 million. That's just, it was 1.5 billion 2 years ago. So it's quite a change for them, and it's going to be a very difficult environment ongoing unless, the Australian government gets policy right in this area.
And just a quick one for you. I mean, is this a suckers rally right now? A lot of people are sitting there and seeing maybe the end of interest rate rises and, markets have responded pretty vigorously here and overseas. So how are you seeing this?
Well, I think, we have been in what one would call a cyclical bear market, and this is obviously a bear market rally. It really does come down to central banks and what they continue to do in terms of rising rates. And overnight again, we've had talk again of further rate rises in the States, that we're not over the peak yet in terms of persistent inflation. So it's one thing for inflation in the US, for example, to go from 9% down to 5%. But what if it stays at 5% for some time? They're going to have to do more.
So
from that
true.
Point of view. And here in Australia.
I've got to jump in there. I apologise for that. Catherine Allfrey from WaveStone Capital. Always great to chat to you, and thank you for your time today.